Right. So today, inshallah, we are going to be looking at the module 7, which is the financial account information exchange. So let me go to the top of the module. Okay. So the whole ambit of today's module is that we'll be able to describe the US and global methods for exchanging financial account information. We'll be able to assess compliance with the FATCA uh, reporting obligations. It's misspelled here, FATCA. Uh, we'll be able to identify the validity of all CRS data captures and reporting obligation, as well as determine how the model competent authority agreements, MCAAs, are structured. So, Foreign Account Tax Compliance Act, FATCA. Let us have a look at it. So, interestingly, the US tax law requires that the US personnel, regardless of their residence, they need to report and pay US federal income tax from all sources. Now, the whole point of enacting FATCA law was to detect the non-US financial account of the US resident taxpayer as well as non-resident US taxpayers. So that was the intention of the act. Given this purpose, reportable US citizens residing outside of US and persons believed to be US persons for tax purposes, uh, and to the non-US personal family members and business partners sharing accounts with the US persons or having US persons signatories on accounts, as well as the reportable persons with positions in non-US companies are required to report. We're going to read soon what is meant by the reportable person, etc. They're required to report to the Internal Revenue Services, IRS, which is the revenue authority of the United States of America. Am I?
Excuse me. Sorry, I'm interrupting. Your screen is not visible.
Oh, I'm so sorry. Let me check
Okay.
that. Is it visible now?
Yes.
Okay, just a second. Let me. Right. So we just discussed that generally what are the different reporting requirements. So basically US citizens are whether they are resident of US or non-resident of US, even uh, even their partners and certain family members, they are all required to provide information to IRS, which is the Internal Revenue Service of USA. So that is the intention, and FATCA law was promulgated in order to detect those information that are usually out of the US for holding of the bank accounts, which are uh, tried to be evaded or not provided to IRS. The information being exchanged through FATCA reporting channel is used by the IRS to identify US persons and their assets and to enable cross-checking where assets have been self-reported by individuals. So cross-checking also is enabled. And or to the FinCEN, which is Financial Crimes Enforcement Network. So US persons, regardless of the residence location and regardless of the dual citizenship, are required to annually self-report their non-US assets to FinCEN, which is usually accomplished by reporting the information on a particular form 8938, statement of specified foreign financial assets. That's the form name, foreign financial assets. Taxpayer identification numbers are and the source of the withholding are also used to enforce asset reporting requirements upon non-resident US citizens. So indirectly, basically through withholding tax agents and other bodies, so there is an indirect enforcement as well. For example, mandatory withholding can be reported via FATCA when a US payer cannot confirm the non-US status of foreign payee. The US government identified the need for FATCA because while the IRS previously required a qualified intermediary, essentially participating foreign financial institutions, FFI, this term we are going to interact quite frequently, uh, to maintain records of of the US or foreign status of their account holders. So there usually, previously there was an intermediary that was doing that, and to report income and withhold taxes. It was reported that the QI participation was insufficient to have substantive impact as an enforcement measure. So an illustration of that weakness was that of the UBS, a Swiss bank, having been registered as an intermediary. Uh, we call it, what was the name? QI was uh, qualified intermediary. Yeah. So what happened there? Having been registered as a QI with the IRS in 2001, but later forced to pay 780 million US dollars in 2009 over claims that it fraudulently concealed information on US person foreign account holders. So, what is the name of this? UBS, we'll remember this. The non-resident US citizens requiring self-reporting of their local assets was also found to be relatively ineffective. uh, the general principle of FATCA is that the US persons are identified when a bank officer applies uh, FATCA indicia. So bank officials who knows a US person's status by other means is also required to identify. So the mandatory, disclosure requirement is there, that the person for FATCA purposes. To implement this requirement, the IRS published another form, W8BEN, in February 2014, which most persons holding an account in a bank are required to complete. Since then, the IRS has required foreign financial institutions to arrange for all foreign account holders to certify their status on Form W8BEN unless an international government agreement was in place authorizing another method of certification. So, quite a few penalties are there. So, the minimum penalty is $10,000. There are substantial penalties for failing to file this Form 8938, which can be $10,000 plus an additional penalty of up to $50,000 if the offender continues to fail to file after being notified by the IRS to do so. A further 40% penalty can be charged for understating taxes attributable to non-disclosed assets. Quite a big penalty. The statute of limitations is extended to 6 years after an entity files its return. And in if the income which was not reported was over $5,000 and is attributable to a specified foreign financial asset. So we will remember the threshold of $5,000 of income. If the income exceeds $5,000, then the statute of limitations is extended to 6 years instead of 5 years. Where a party to fail to file were a party to fail to file a proper report to properly report an asset on this particular form 8938, the statute of limitations for the tax year is extended for 3 years beyond the time when the party provides the required information. So there is another 3 years extended. If there is a reasonable cause for the failure to file, then the statute of limitation is extended only with regard to the item or items related to such failure and not for the entire tax return. A penalty is not imposed if the failure to disclose is found to be reasonable, although this is decided on a case-to-case basis. So FATCA reporting, let us have a look at it. The first thing is what is to be reported. So scope. FATCA requires foreign financial institutions to identify from their customer databases all account holders suspected of being US persons. For this purpose, searching according to FATCA indicia is conducted by reference to US place of birth, identification of the account holder as a US citizen or resident, current US residence or mailing address, including a PO box, a current US telephone number, standing instructions to pay the amounts from a foreign, meaning non-US account to an account maintained in the United States, current power of attorney or signatory authority granted to a person with a US address. So it's quite stringent. It seems that not only the citizens, but also US residents are subject to FATCA. US in care of or hold mail address being the sole address with respect to the account holder. US entities making payments to non-compliant foreign financial institutions are required to withhold tax equal to 30% of the amount. So, foreign financial institutions, which are themselves the beneficial owners of such payments, are not permitted a credit or refund for taxes withheld without a treaty override. So, uh, foreign financial institutions, if they are beneficial owners of such payments, so they are not allowed tax relief basically, unless there is a treaty override. So, who needs to report? The foreign financial institutions are required to report the information to the US competent authority, which then shares the data with the IRS under the intergovernmental agreement entered with many countries. So, each foreign financial institution sends the US person's data to the local competent authority, which in turn sends the data to the US competent authority. For example, according to Ukraine's IGA with the US, the US person's data is sent to US via the Ukrainian government portal. So, Mr. Tanu, can I ask you this question if you can contribute to it? Like, in your experience, which would be the local competent authority in UAE? Is it the FTA itself or another entity?
MOF.
Ministry of Finance. Okay. A foreign financial institution is any financial institution that is a foreign, in other words, non-US entity, and which accepts, naturally, these are the common features of a financial institution: deposits, ordinary course of banking or a similar business, holds financial assets for others as a substantial portion of its business, or is primarily engaged in the business of investing, reinvesting, or trading securities, partnership interest, commodities, etc., or any interest, including futures and forward contracts on the assets. So quite a broad definition. Although I think credit facilities are not mentioned here, so this is essentially on the deposit taking. For FATCA, an investment entity broadly means an entity which conducts as a business or is managed by an entity that conducts as a business one or more of the following activities. Now we are talking about investment entity. Previously it was foreign financial institution. Now we're talking about an investment entity. So the if that entity does the following business, then it will be an investment entity. Let us have a look at it. Uh, Trading in money market instruments, checks, bills, certificates of deposits, even derivatives, foreign uh, exchange, interest rates and index instruments, transferable securities, commodity futures. So quite a few investment companies in DIFC are or ADGM are doing that. Even in mainland, we have individual and collective portfolio management or otherwise investing, administering, or managing funds or money on behalf of other persons. For this purpose, the financial account means an account maintained by a financial institution and includes, so this will always be meant by what is a financial account. Let us have a look at it. In the case of an entity that is a financial institution, solely because it is an investment entity, uh, any equity or debt interests other than interests that are regularly traded on an establishment security markets uh, in the financial institution. So in case of an entity that is financial institution solely because it is an investment entity, any equity or securities in the financial institution. That's the that's the first financial account. So I think CDC accounts will also be covered. CDC means central depository. In the case of a financial institution not qualifying under the definition, uh, any equity or debt interest in the financial institution other than interest regularly traded on an established securities market, any equity or debt interest. So, what is the difference between the two? Let us have a quick look at it. In case of an entity that is a financial institution, solely because it is an investment entity, any equity or debt interest in the financial institution. So this was purely for investment entity. But this was slightly different. In case of a financial institution not qualifying under the definition, any equity or debt interest in the financial institution. So uh, other than interest regulated traded in the stock market, now, further conditions are provided if the value of the debt or equity interest is determined directly or indirectly, primarily by reference to assets giving rise to US source withholdable payments. So basically, US source withholdable, if there are such payments on which US tax should be withheld, so that kind of a payment and that kind of an account will be subject to uh, will be under the definition of the financial account. And second, the class of interest was established with the purpose of avoiding reporting in accordance with the rules. So it was a cleverly contrived, method or account or an arrangement whereby the intention was to avoid reporting to IRS that there was a withholding tax obligation or other reporting obligation. Any cash value insurance contract uh, and any annuity contract issued or maintained by a financial institution other than a non-investment linked, non-transferable, immediate life annuity. So here the keyword is life. So if it was non-investment linked or non-transferable life annuity, then it will be out of the scope of the definition of foreign account. Otherwise, they will be covered. Issued to an individual and monetized by a person or disability benefit provided under an account excluded from the financial account definition. So naturally, I mean, this is uh, from a perspective of social welfare or benevolence. Why? Because this is purely for the benefit of the individual's life, particularly, or for that matter, disability. The FFIs include but are not limited to depositories, custodial institutions, investment entities, including private equity or hedge funds, certain types of insurance companies with cash value products or annuities, direct reporting, non-financial foreign entities, and sponsoring entities. So the ambit or the scope has been quite broadened for the definition of foreign financial institutions. So quite a almost every type of financial institution has been brought into the definition, even the central depositories. You have learnt about the foreign financial institution, but in order to fully understand FATCA reporting, you will need to understand what specified foreign financial assets and withholding agents are. Let us have a look at the specified foreign financial assets. Okay, specified foreign financial assets are foreign financial accounts and foreign account assets held for investment. So specified foreign financial accounts and foreign non-account assets held for investment as opposed to held for use in a trade or business. So wherever the word investment comes, there is a sense of passiveness. Uh, in why? Because that is the passiveness takes it out of the scope of trade or business, including depository or custodial financial accounts maintained at a foreign financial institution, and to the extent not held in an account at a financial institution, such as stocks or securities issued by foreign corporations, any other financial instrument or contract held for investment that is issued by or has counterparty that is not a US person. So if it is like it is stocks or securities that were issued by foreign corporations, that will not be within the scope uh, of subject for financial assets. Similarly, the stocks or investments in a non US person, that will also go out. Any interest by any interest in a foreign entity. So, and then we're talking about withholding agents, any US or foreign person having control, receipt, custody, disposal, or payment of any item of income of a foreign person that is subject to withholding is considered to be a withholding agent. So, so many financial institutions operating in UAE, they will be within the ambit of the withholding agent. Why? Because UAE has already an IGA with the FATCA intergovernmental agreement. So let us, having been introduced to the US system requiring reporting to the IRS on accounts at banks outside the US held by a held by or for a US person, you should know now have the knowledge to test whether the UAE has aligned to the US rules in, oops, I can't read this. Uh, so I think oh, this thing is stopping me from reading. But anyways, there was a mention of a penalty here, I think, which there it is. You should now have the knowledge to test whether the UAE has aligned to the US rules in the procedures which it has adopted in order to avoid 30% withholding tax. This is the amount of tax that is supposed to be withheld. You know, that's quite a big amount on FATCA. Uh, Required by the FATCA, uh, automatically deducted from payments made by a UAE financial institution to a US resident account holder. Okay, so UAE-US FATCA IGA, Intergovernmental Agreement. In this section, we introduce you to the UAE FATCA rules in order for you to have the knowledge to determine whether a company being audited has complied with any applicable FATCA reporting obligations to avoid penalties which would need to be booked. The FATCA agreements which the UAE has entered into are there are two agreements: UAE USA FATCA Model 1B agreement signed in 2015, which is the basic architecture, which entered into force in 2016, and the second one is UAE US Competent Authority Agreement released on 29 July 2016, operational requirements. So basic structure and operational requirements. In entering into IGA Model 1B, the UAE has adopted the FATCA model for non-reciprocating countries, an approach which is anticipated since the UAE financial institution may not be able to comply with certain aspects of FATCA due to domestic legal impediments. So basically, the UAE has adopted the FATCA model for non-reciprocating countries, like which do not basically reciprocate the actions that are proposed by UAE, or for that matter, they are which are proposed under the FATCA. So, whatever treatment the other country is doing, UAE will do the same treatment. If they are not cooperating, UAE will also not cooperate. We will now review the main operation provisions of the UAE US IGA. Let us have a look at it. Financial institutions. So definition include the US UAE IGA is the standard model 1B definition and will apply to many UAE resident companies. Let us have a look at the term is the term is defined to mean custodial institution, depository institution, investment entity, or a specified insurance company. Let us have a look at all of these four definitions. First of all, custodial institution. A custodial institution is an entity holding as a substantial portion of its business financial assets for the account of others. An entity holds financial assets for the account of others as a substantial portion of its business if the entity's gross income attributable to the holding of financial assets and related financial services equals or exceeds 20% of the entity's gross income during the shorter of the 3-year period ending on December 31 uh, prior to the year in which the determination is being made. So basically, last 3 years gross income, if the income from custody of financial assets is more than 20%, then that institution will be seen or deemed as a custodial institution, or the period during which the entity has been in existence. So which is basically a shorter period if they don't have 3 years period. Second, depository institution. A depository institution is an entity accepting deposits in ordinary course of a banking or similar business. So great, that's easy to understand. And then the third one is investment entity. An investment entity conducts as its business or is managed by an entity that conducts as business one or more of the following activities or operations for or on behalf of a customer. Now, I think we're talking about the investment advisors and investment management companies. Trading in money market instruments, checks, bills, certificates of deposit, CODs, derivatives, foreign exchange, interest rate, and index instruments, transferable securities, or commodity futures trading. So, quite a few companies on DMCC are also under the scope. Or individual and collective portfolio management, individual and collective portfolio management, or otherwise investing, administering, or managing funds or money on behalf of other persons. So, does anyone know, other than Mr. Tanu, does anyone know what is DMCC? Haya, are you aware?
Somewhat.
Dubai Multi Commodity Exchange. This is the exchange. Uh, Basically, DMCC is Dubai Multi Commodity Center, I think. But it's an exchange on which commodities are traded, basically. Okay, gold, platinum, wheat, sugar, whatever it is. So quite a few entities trade into commodities as well. Oil, for example, gold. So anyways, United Arab Emirates financial institutions, let us have a look at it. All financial institutions in the UAE qualify as UAE financial institutions because the IGA, Intergovernmental Agreement, applies to an FI organized under the laws of the UAE, but excluding one or more non-UAE located financial institution branches. What are we looking at? So what we are looking at is United Arab Emirates financial institution. The financial institution in the UAE qualify as UAE FIs because the IGA applies to an financial institutions organized under the laws of the UAE, but excluding one or more non-UAE located branches, basically. So, a UAE branch of a foreign institution organized under the laws of a country other than the UAE. So, both categories. First was compliance with the UAE laws, but excludes one or more non-UAE located branches. So in certain other countries, some branches of a UAE financial institution may be, if you even if we exclude that financial institution, will still be considered as UAE financial institution, and some branches which are subject to laws of another country located out of UAE. Non-reporting UAE financial institutions, it does not mean that all financial institutions are reporting financial institutions. This follows because UAE financial institutions or other entity resident in the UAE can be non-reporting UAE FI under one of the Annexure 2. So, very interesting. It does not mean that all FIs are reporting FIs. This follows because financial institutions, UAE financial institution, or another entity resident in UAE can be a non-reporting UAE financial institution. Even though the entity is in UAE, resident in UAE, they can be non-reporting financial institution under one of the Annexure 2 tests, which include but are not limited to financial institutions with a local client base. A UAE bank, financial institution with only low value accounts, a qualified credit card issuer, a trustee document trust, or a sponsored closely held investment vehicle, or a UAE financial institution which qualifies as a deemed compliant foreign financial institution, or an exempt beneficial owner under the relevant US Treasury regulations. So, in short, if there is an Annexure 2 in the intergovernmental agreement which can identify that while the entity is resident in UAE, it will still be a non-reporting UAE financial institution. So, it will not need to report. Deemed compliant foreign financial institutions. A deemed compliant foreign financial institution is not required to register with the IRS. So, uh, a certified deemed compliant foreign financial institution means an FFI that has certified as to its status as a deemed compliant foreign financial institution by providing a withholding agent with the documentation applicable to the relevant deemed compliant category. So, to attain the status of deemed compliant foreign financial institution, one necessary information must be provided to IRS that we have there is a dedicated withholding agent and other criteria must be met. And if the institution attains the status of a deemed compliant foreign financial institution, they do not need to register with IRS. US reportable account. A reporting financial institution is required to report on a US reporting account. An account qualifies when it is maintained by a reporting UAE financial institution held by one or more specified US persons. So, will probably this specified US person will also come ahead. We haven't had this definition yet, but the summary of it is that if a specified US foreign person holds an account in a UAE financial institution, reporting UAE financial institution, then that will be a US reportable account. The account is not reportable if it is not identified as a US reportable account after having completed the due diligences. So some of the definitions: entity. An entity is a legal person or a legal arrangement such as a trust. So, very interestingly, trust is not really a legal entity with a separate personality, but it is an arrangement. But in the context of FATCA, it will still be seen as an entity. Second, US person. Only US persons can be reported on. So that's a very important point. So what is a US person? A US citizen or resident individual, a partnership or corporation organized in the US or under the laws of the US or any US state is a US person, as is a trust if a US court has authority to make orders or judgments concerning substantially all issues regarding the trust's administration. One or more US persons controls all substantial decisions of the trust or an estate of a decedent uh, uh, that is a citizen or resident of the US. In short, if the US law applies, if the entity has been formed under US laws, that's a US person. Specified US person, let's have a look at it. Of all the US persons, only certain US persons need to be reported. Who are those? A person is a US specified person if he or it, he refers to natural, it will mean the legal. If he or it is a US tax resident, except when the person meets one of the exemptions. So in short, if the person is a US tax resident, only then that will be seen, he or it or she will be seen as a US specified tax resident person unless exempted. These include, but are not limited to, a corporation, the stock of which is regulated, traded on one or more established securities market or an affiliate. So the US or any wholly owned agency or instrumentality. So any agency of the US, any organization exempt from US taxation under the relevant sections of the Internal Revenue Code, IRC, or an individual retirement plan is defined in section 770, etc. of the IRC Internal Revenue Code. Any bank as defined in section 581 of the IRC. So certain banks, trusts, wholly owned agencies, all of them are exempt. A dealer in security, commodities or derivative financial instruments, including notional principal contracts, futures, forwards and options, registered as such under the laws of the US or any of the state. A broker as defined in section 604C of the Internal Revenue Code. So these are various components of who are exempted, and naturally by default they're not going to become the US specified persons. So the key sentence here to remember is not all US persons need to report for FATCA purposes. Only the specified US persons need to report. Now we're looking at controlling persons. A look-through applies to determine real owners of a company or a trust. So real, you could also think of it as beneficial owners of a company or trust. The natural persons exercising control over an entity and a trust means the settler, the trustees, the protector, if any, the beneficiaries or class of beneficiaries, and any other natural person exercising ultimate effective control over the trust. And in the case of a legal arrangement that other than a trust, persons in equivalent or similar options. So the meaning of controlling persons is interpreted in a manner consistent with the Financial Action Task Force recommendation. So naturally FATF has issued guidance on the ultimate beneficial ownership. Recommendation mean that natural persons who ultimately own or control a customer and or the natural person on whose behalf a transaction is being conducted. So that is the real owner or the ultimate beneficial owner. It also includes those persons who exercise ultimate effective control over a legal person or arrangement. A reference to ultimately owns or controls an ultimate effective control refers to a situation in which ownership or control is exercised through a chain of ownership or by means of control other than the direct control. So, the control can be demonstrated through a chain as well, through other people as well. So the whole idea is that the ultimate beneficial owners will the doctrine of ultimate beneficial owners will decide uh, who controls the trust. Information to be shared. The information to be exchanged on a reportable account is detailed in Article 1GA, I think, or article reference is not mentioned, but there is an article in the uh, intergovernmental agreement. That article requires that the UAE to gather specified information on all US reportable accounts and annually automatically exchange that information with the US. Specified information is, the general particulars like name, address, US TIN, tax identification number of each specified US person, which is an account holder. And in the case of a non-US entity, that after application of the due diligence procedures is identified as having one or more controlling persons, which are specified US person. The name, address, and the US TIN, if any, of such entity and each other specified US person. So, essentially all the regulatory related information, the tax number, tax identification number, name, address, etc., account number, functional equivalent in the absence of an account number, name and identification number of the reporting UAE financial institution, account balance of value, including in the case of a cash value insurance contract or annuity contract, the cash value or surrender value at the end of the calendar year, or if the account was closed during the year, immediately before the closure. All of these information have to be provided for basically in US for the US reportable accounts. If the account is a custodial account, the information to be exchanged is total gross amount of interest, total gross amount of dividend, total gross amount of other income generated from the assets held in the account. So that financial institution will have to report this. In each case, paid or credited to the account during the calendar year, and total gross proceeds from the sale or redemption of property paid or credited to the account during the calendar year, with respect to which the reporting UAE financial institution acted as the custodian, broker, nominee, or otherwise as an agent for the account holder. So these are the reporting obligations of the reporting UAE FI financial institution. If the account is a depository account, so now we are moving to the depository scenario. Then the information to be exchanged is the total gross amount of interest paid or credited to the account during the calendar year. So, which were the depository institutions or depository organization? We read a definition a little while ago. Anybody? What is a depository account? It was one type of financial institution, if you recall. Those who accept deposits. So depository account means where the deposits are maintained. If the account is an account other than one of the foregoing, then the information to be exchanged will be the total gross amount paid or credited to the account holder during the calendar year, with respect to which reporting UAE financial institution is the obliger or debtor. So how much amount was credited or paid, that will need to be reported by the UAE financial institution. This includes the aggregate amount of the redemption payments made to the account holder during the calendar year. Time and manner of information exchange. IGS specifies the time and manner of the information exchange. Article 3 specifies that the characterization of payments made on a US reportable account is determined by applying the UAE laws, and the information exchange is nominated in the original currency. So original currency, it should be reported in original currency itself. Just a second, guys. Right. In relation to when the information exchange, paragraph 3 of the competent authority arrangement confirms the automatic exchange occurs within 9 months after the end of the calendar year to which the information relates. So the maximum time limit is within 9 months of the end of the calendar year to which. So you guys might find this 9 months common with the corporate tax as well. Can you guys think of what is that commonality? No answer? The tax return must be filed within 9 months of the close of the fiscal year. Application of FATCA to UAE financial institution. The reporting is simplified for UAE financial institutions under Article 4 of the Intergovernmental Agreement, in that each is deemed compliant and not subject to withholding under Section 1471 of the Internal Revenue Code, providing the UAE complies with its obligations to collect and annually exchange information on the reporting UAE financial institutions US reportable accounts. So what were we looking at? So basically this is at an intergovernmental level. So, and the whole idea is that uh, if the UAE financial institutions comply with the exchange of information requirements, then UAE will be seen as compliant with the IGA. Let us have a look at. Uh, it is important to differentiate between a non-reporting UAE financial institution and a reporting UAE financial institution. So let us have a look at non-reporting UAE financial institution first. So non-reporting UAE financial institution is any UAE financial institution or other entity which is UAE resident and described in the IGA annexure as being a non-reporting UAE financial institution, or which otherwise qualifies as a deemed compliant FFI. We read a little while ago that deemed compliant FFIs will be certain financial institutions which have already appointed it, which have demonstrated that a withholding agent exists, and or they are exempted under various scenarios that were provided in the Internal Revenue Code of the US. So the such financial institution will be considered as non-reporting financial institution or an exempt beneficial owner under the US Treasury regulations. That's an easy one. Any UAE financial institution that is not a non-reporting UAE financial institution is a reporting financial institution. But the key thing to remember is they have been provided in the annexure. So in the IGA, Intergovernmental Agreement between US and UAE, addressing the FATCA obligations, the institutions have been identified, or otherwise they should be able to claim that exemption. Active non-financial foreign entity. A reporting UAE financial institution will not be required to report on accounts it holds if the account holder is an active non-financial foreign entity. Any non-US entity treated as a financial institution. Uh, an active non-financial foreign entity is an NFFE satisfying any of the following criteria. Just a second. First, criteria: less than 50% of the NFFE's gross income. What was that NFFE? Non-financial foreign entity. 50% of the non-foreign financial entities, non-financial foreign entities, gross income for the preceding calendar year is passive income, and less than 50% of the assets held by the non-financial foreign entity, less than 50%, during that preceding calendar year are assets producing or are held for the production of passive income. So that non-financial foreign entity, it has less than half of their gross income is passive income, less than half of the assets produced that income. So that will qualify as a non-financial foreign entity. The stock of the non-financial foreign entity is regularly traded on an established securities market, or the non-financial foreign entity is a related entity of an entity, the stock of which is regularly traded on an established securities market. Let us have a look at it again. The stock of the non-financial foreign entity is regularly traded on an established securities market, or that entity is a related entity of an entity, the stock of which is regularly traded on an established securities market. So why? Because established securities market have very stringent regulatory and disclosure requirements. So that will be considered as a non-financial foreign entity. NFFE is organized in a US Treasury, and all payees owners are bona fide residents of the US territory. So not treasury, but US territory. So that non-financial foreign entity is organized in a US territory, and all the payees are also residents of that territory. Non-financial foreign entity is a government other than the US government, a political subdivision of such government, or public body performing a function of that government or a political subdivision thereof, a government of a US territory, an international organization, a non-US central bank of issue, or an entity wholly owned by one or more of the foregoing. So if basically US under the US dominion basically, so that will also be here. So why are we reading this? A reporting UAE financial institution will not be required to report on account if it holds an account holder in an active NFFE. So if these conditions are being met, the reporting requirements will be exempted. Let's look at the next one. Substantially all of the non-financial foreign entities activities consist of holding stock of or providing financing or services to one or more subsidiaries, engaging in trades or businesses other than the business of a financial institution. So substantially all of the activities are, substantially all of the activities are do not comprise financial institution activities, except that an entity is not an NFFE if the entity functions or holds itself out as an investment fund. So now the concept of hold itself out means the legal term is estoppel. When you hold out on behalf of someone or you present yourself as holding a particular position, meaning your ability to you are presenting yourself as that, I am authorized to speak on behalf of someone, that's holding out. So except that an entity is not an NFFE if that entity functions or holds out as an investment fund. So then naturally this will be required to report, such as a private equity fund, venture capital fund, leverage buyout fund, or any investment vehicle whose purpose is to acquire or fund companies and then hold interest in those companies or capital assets for investment purposes. So basically the whole idea is that the NFFEs who consist holding of stock or providing financial services or more or it engages in trades or business other than the financial institution, then there is no requirement except the below if it holds out as an investment operation. NFFE is not yet operating a business and has no prior operating history, but is investing capital into assets with the intent of operating a business other than that of a financial institution. So it is not a non-operational or still not commenced business and has no prior operating history, but is investing capital into assets. So, with the intent of operating business other than that of a financial institution. But the NFFE will not qualify for this exception after 2 years after the NFFE's incorporation, or NFFE was not a financial institution in the past 5 years and is liquidating its assets or reorganizing to continue or commence operations in a business other than the financial institutions. So for the last 5 years, it did not do the business of a financial institutions or liquidating assets or organizing to continue the recommended operations in a business other than the FI. NFFE primarily engages in financing and hedging transactions with or for related entities only that are not FIs. So, yeah, that's an internal arrangement and does not provide financing or hedging services to any entity that is not a related party. So, it becomes a third party. Then it means that it is engaging into an independent business which is not for the internal or group purposes. Providing the group of any such related entities is primarily engaged in a business other than that of a financial institution. So the key trigger point is the business of a financial institution. If the NFFE does not directly or indirectly engage into the actions or business of a financial institutions for third parties, then it will be seen as an active NFFI, NFFE, and not be required to submit FATCA related information. NFFE is an accepted NFFE as described in relevant US Treasury regulations. So then, I mean, this is kind of an extra measure to cover that despite providing all the conditions before the previous 8 different scenarios, even then there might be a need to further specify. So then there will be notifications issued by the US Treasury that these specific organizations are not going to be required to report their FATCA related information. So these are accepted NFFEs. The following criteria applies in the jurisdiction of residence. So let us look at the criteria. It is established and operated in its jurisdiction of residence exclusively for religious, charitable, scientific, artistic, cultural, athletic, or educational purposes. Please remember, we are looking at non-financial. So, non-financial foreign entities. So naturally, these are all social welfare and other related objectives. It is established and operated in that jurisdiction of residence, and it is a professional organization, business league, chamber of commerce, labor organization, agricultural. So basically, associations. It is exempted from income tax in its jurisdiction of residence and has no shareholders or members who have a proprietary or beneficial interest in its income or assets. Now, interestingly, what we are looking at is foreign jurisdiction. The following criteria applies in the jurisdiction of residence. So, non-financial foreign entity. So, in it is exempted from income tax in that foreign jurisdiction. Has no shareholders or members who have proprietary or beneficial interest in the income or assets, and NFFE's jurisdiction jurisdiction applicable laws or the NFFE's formation document do not permit any income or assets to be distributed to or applied for the benefit of a private person or non-charitable entity other than pursuant to the conduct of the non-financial foreign entities charitable activities. So the basically it all revolves around the charitable mandate. So if you're not distributing to persons of commercial interest, or you're deviating from the charitable mandate, then it will no longer have the benefit of being a non-financial foreign entity, or as payments of the reasonable compensation for services rendered, or as payment representing the fair market values of the properties which the NFFE has purchased. And the NFFE's jurisdiction of residence law or the NFFE's formation document require that the assets or liquidation of the NFFE to be distributed to a governmental entity or other non-profit organization. So if you look at it, the following criteria applies to jurisdiction. So if you find one common feature in all of the various provisions that were mentioned, is that the charitable mandate overrides. Whenever it deviates, it will lose the benefit of being a non financial foreign entity and will become subject to FATCA reporting if it interacts with if it has information or it holds account of specified US persons. You have been introduced to the FATCA rules and to the IGA entered between the US and the UAE, and have learned which accounts are required to be reported to the US, which information is to be reported to the US, and when the reporting is to be made. Having completed the topic so far, you have sufficient knowledge to test whether a company being audited is complying with the FATCA law. Let us go to the next topic of common reporting standards. Uh, is there any questions or comments or anything that anyone would like to share with me at this stage?
No.
Okay, perfect. Let's move to the next stage. So we have Abbas has joined, Absar is there, Farjad is there, and Haya and Mr. Tanu is there. Momin has also joined, I think. Good. Common reporting standard. The section will introduce you to the global and UAE architecture on which the UAE CRS rules operate. Haya, have you worked on common reporting standards before, or anyone?
No.
No. The objective is to build knowledge in order that you may be able to validly test the booking of provisions for fines and or penalties, and the failure to comply, and that you may also assist clients in rectifying any shortfalls in their common reporting standards date capture and reporting obligation. Now, while FATCA is the exchanging system for the US, the CRS is the single global standard for the collection, reporting, and exchange of financial account information on foreign tax residents. Under the CRS, banks and other financial institutions collect and report the country in which the account holder is a tax resident, or financial account information, or foreign tax resident. The CRS, I have seen that in UAE, in Oman, in Saudi Arabia, the CRS departments are already established in their revenue authorities. So people from India and Pakistan who are on this call today, I'd like to ask you, have you experienced anything in the Federal Board of Revenue in Pakistan or the Indian Revenue Authority, that CRS departments are established? Have you interacted with them? I don't think you
No.
you guys have. Okay,
No.
the CRS
Yeah.
was developed in response to a G20 request. Again, OECD comes into play here actually. So that is why, while FATCA is purely US oriented, and it interacts with other countries, so it's the interaction between US and other countries. CRS is a much more it's a more global framework basically. It was developed in response to G20 requests and approved by the OECD Council on 15 July 2014. The CRS requires jurisdictions to obtain information from the financial institution and automatically annually exchange that information with the other jurisdiction. That's why the tax authorities come into play. It describes the financial account information to be exchanged, financial institutions required to report, the different types of accounts and taxpayers covered, as well as common due diligence procedures to be followed by the financial institution when identifying the account holder for whom reporting is required. So, what are the four areas? First one is the Model Competent Authority Agreement, providing the international legal framework for the automatic exchange of CRS information. That agreement is basically signed between the revenue authorities or the governments. Then we have the standards themselves, CRS Common Reporting Standards. Then commentaries on the model agreement that we are talking about, that's it's a detailed document. The CRS XML schema user guide. There is a user guide as well. Let us first of all look at the model agreements of common reporting standards. You'll be introduced to the basic architecture of the CRS Information Exchange Agreement, which is intended to facilitate the decision when reviewing the UAE's competent authority agreements and the extent of alignment or divergence of the UAE's competent authority agreement from the model OECD CAA. Over 100 jurisdictions have committed to exchanging information with each other under the CRS. The exchange relationship between the jurisdictions are typically based on the multilateral convention on mutual administrative assistance in tax matter. So it's this if you recall, there was a BEPS 1 project also done. So under which there was a requirement of exchanging information and mutual administrative map procedures. So there is a detailed convention on maps basically. So 100 countries of the world have actually signed up for this convention, in which more than 100 jurisdictions are participating. And the CRS, Multilateral Competent Authority Agreement, which is based on its Article 6. So under this convention, basically, it was agreed in the Article 6 that we are going to come up with a model agreement so that two countries who are signing that agreement may refer to that convention. Jurisdictions may alternatively rely on a bilateral agreement, such as a double tax convention or a tax information exchange agreement, TIA. In addition, certain CRS exchanges takes place on the basis of the relevant EU directive agreements as well between the EU and third countries, and bilateral agreements such as the UK CDOT agreements. So uh, US is dealing with US enforces FATCA, but other than that, rest of the countries of the world usually follow the this competent authority model competent authority agreement. So the CRS MCAA applies the details of what information will be exchanged and when. It is a multilateral framework agreement, a particular bilateral relationship under the CRS Model Competent Authority Agreement becomes effective only if both jurisdictions have the convention in effect. So only those 100 jurisdictions, they will likely sign the MCAA, have filed the required notification under Section 7 and have listed each other. So there is a depository in OECD. That's where the bilateral agreements after signing are submitted. The competent authority of the jurisdictions listed in Annexure A, that is the non-reciprocating countries, will send but not receive the specified information, while the competent authorities of jurisdictions not listed in Annexure A will always receive the specified information. So non-reciprocating jurisdictions are also there. So they will provide the information, but they may not receive. Competent authorities will not send any specified information to the competent authorities of the Annexure A jurisdictions, which are non-reciprocating jurisdictions. Let us have a look at the model agreement, basically model convention. MCA sets out the information to be exchanged in relation to each reportable account of another jurisdiction. The specified information is number one, for individuals, the name, addresses, TIN number, place of birth, etc. Of each reportable person, that is an account holder of the account. And secondly, for an entity that is an account holder and is identified as having one or more controlling persons, each of which is a reportable person, then again, name, TIN number, place of birth, the common things of each reportable person. The account number or equivalent in case that account number does not exist, name and identifying number, if any, of the reporting financial institution, the account balance or value, including the case of a cash value insurance contract or annuity contract, the cash value or surrender value at the end of the relevant calendar year, or if the account was closed during such year or period, the closure date of the account. So basically all the cash value, the balance and cash value, how much amount is there, that information has to be shared. Then other than that, there are scenarios of custody as well. So for custodial accounts, the total gross amount of interest, total gross amount of dividend, total gross amount of other income, it is very similar to what we read in FATCA, if you recall. These are the same thing for custodial accounts, exact same things were mentioned there. Other income generated with respect to assets held in the account in each year, paid or credited to the account during the calendar year. Total gross proceeds from the sale or redemption of financial assets paid or credited to the account during the calendar year with respect to which the reporting financial institution acted as a custodian, broker, nominee, or otherwise as an agent for the account holder. Then we have depository account, the total gross amount of interest paid or credited to the account during the calendar year or other appropriate reporting period. So that is depository account. Account not described above, the total gross amount paid or credited to an account holder on the account during the calendar year for which the reporting financial institution is the obliger or debtor. Exact same things were mentioned in FATCA as well. So, including the aggregate amount of any redemption payments made to the account holder during the calendar year. So, if you summarize the whole thing, basically, in case of custodial accounts, you know, all the movement, all the particulars of the persons for whom have to be reported, that information needs to be provided. How much payment was there? What balance was there? All common uh, features. The amount and characterization of the payments made on a reportable account may be determined by applying the tax laws of the jurisdiction, exchanging the information. And the information exchange will identify the currency in which the relevant amount is denominated. Uh, I'd like to ask a question from the practitioners on this call. Why would one competent authority, for example, let's say IRS, Internal Revenue Service of US, reach out to ZATCA or Federal Tax Authority to seek information regarding a, a, a person uh, for exchange of information? Can somebody comment on that? Haya,
Mm, no.
or any other person if you want to speak. Come on, guys, this is important. Like, why would IRS want to have information from the financial institutions in UAE? You guys, maybe tomorrow you might be interacting with financial institution or doing an audit over there. Why does the FATCA require this information? Or for that matter, why would a uh, HMRC in UK require in that, all this information of accounts held by their citizens or residents or from the tax
To,
authorities? Why would they do that?
to check the credibility of the like tax returns, or you can say what they have reported so far to the authority.
Is the okay that which authority? Like the domestic authority of UAE or Saudi Arabia, or the institution that is asking for this information?
Who I think if you're talking about like regarding this topic which we are actually going through,
Hmm.
who are registered with MFFE as who are
Okay.
actually registered, like who have to report.
Parjad, what is your view? Is Farjad there? Farjad, you are on mute. Okay, I don't think anybody is participating right now. Absar, Farjad, anybody who would like to speak on that other than what Haya has mentioned? So, guys, think about it this way. Uh, for the US citizens are already subject to tax. Even US residents are subject to tax on their worldwide income. That's from a US perspective, it will happen this way. But other countries, UK or European jurisdictions, uh, that account holder may be subject to tax over there, and he may be claiming for a tax relief on the tax that they have already paid. Or for that matter, if the laws of the other of that foreign jurisdiction require that the worldwide income needs to be reported there, and the account holder is sitting in US or Saudi Arabia, and he's hiding that information of a lot of business or assets being maintained here in other jurisdictions, Saudi Arabia or UAE or GCC countries, then the only way to become aware of that tax evasion is the exchange of information. CRS, Common Reporting Standards, or FATCA, these are those mechanisms through which billions of dollars of tax is reaped by those revenue authorities. They reach out to other authorities, they ask for information, and if there was any hidden there was any financial information that would have been taxed in those other foreign countries, that information becomes available. We just saw one example. Haya, can you recall that example? Which was that Swiss bank? There was a
No, I
Swiss bank,
can't recall.
uh, UBS, I think. UBS had to pay how much amount? How much amount of penalty UBS paid to IRS? 780 million dollars, if you recall. So that is that was one entity that paid the amount to IRS. Can you imagine the rest of it? Like that is why this topic is relevant here, and it will become it's part of the international taxation. Anyways, information is to be exchanged within 9 months after the end of the calendar year to which the information relates, and will only be exchanged if both competent authorities have entered into CAA agreement. And the respective jurisdictions have in effect legislation requiring reporting, and that legislation is consistent with the CRS procedures. So this is a multilateral convention So, this CAA, Competent Authority Agreement, is a multilateral convention which is signed under either OECD, or if it is a FATCA IGA, then it is again uh, an intergovernmental, it's a bilateral treaty, and it is these agreements are protected by the Vienna Convention. What would that mean? That if the local or the domestic law tries to undermine provision of this information because of the Vienna Convention, the other country, like was the case with the Switzerland, they are compelled to comply with the law of the international law, and that's why they would provide information. So these things that we are reading, they sometimes override the domestic law of the country. Competent authorities will automatically exchange the information in the CRS schema in extensible markup language XML, and will work towards and agree on one or more methods of data transmission. So including encryption standards, etc. So basically information is exchanged under these agreements. Let's look at the terms of the agreement. A competent authority must provide, when the CAA is signed or as soon as possible thereafter, a notification to the coordinating body secretariat that its jurisdiction has the necessary laws in place to implement the CRS. So basically what is happening here, two competent authorities are talking to each other basically. As soon as it is signed, the competent authority must provide when the CA is signed, or as soon as possible. After signing of the CA, basically this information is provided to the notification to the coordinating body secretariat that its jurisdiction has the necessary laws in place. FTA will provide this information that UAE has necessary laws in place to implement CRS, and specifying the relevant effective dates for the pre-existing accounts, the new accounts, and the application to to completion of the reporting and due diligence procedures. Also confirming whether the jurisdiction is a non-reciprocal jurisdiction. Uh, this, where will that be mentioned? Non-reciprocal jurisdiction. There was an annexure. Can you guys remember? In the model,
Yes.
yeah, model agreement, if you recall, model convention, there is an annexure which identifies non-reciprocal jurisdictions. And what is the consequence of that? If one country is a non-reciprocal jurisdiction which is listed in that annexure A, what is the consequence of that? Let's say, for example, some African country which is listed as a non-reciprocal jurisdiction in the model agreement MCAA in annexure A, and it signs that CRS agreement, that MCAA with UAE. What will that mean? Can somebody give me an answer? Like here, UAE, FTA
That
reaches out. Yeah,
that company wouldn't be reporting, like it would be non-reporting.
no, the consequence will be that UAE's Federal Tax Authority can ask information from that African country, and they will be compelled to provide that information, exchange the information, right? But if that African country reaches out to FTA saying that we need some information, FTA will not provide. That's the consequence of a non-reciprocal jurisdiction. Clear? Specifying
Yes, got it.
specifying one or more methods for data transmission, including encryption in Annexure B. So basically, this is all procedural level detail at how data will be transmitted. Specifying safeguards, if any, for the protection of personal data in Annexure C. So what are we looking at? What we are looking at are the terms of the MCAA or the CAA, Competent Authority Agreement. So how will the data will be protected, etc., etc. Uh, Specifying safeguard for the personal data protection. It has it has a place adequate. It has in place adequate measures ensuring the required confidentiality and data safeguard standards are met, and providing the NHD completed confidentiality and data safeguard questionnaires. So basically, data protection, listing the jurisdictions of the competent authorities for which it intends to have an effective CAA following national legislative procedures. So, in short, the authorities will exchange this type of an information as well as soon as a convention is signed between two countries. Competent authorities must notify the coordinating body secretariat. This is most probably this is OECD they are talking about. OECD has a body called coordinating body secretariat promptly of any subsequent change to be made to the above mentioned annexure. Let's move to in September 22 OECD portal discloses the UAE having entered into arrangements with 78 countries to exchange information, each of which relies on the model competent authority agreement to exchange information. So when you are here in UAE, inshallah, you guys, and you're practicing, if you're not already here, you will face situations where people from European Union or particularly USA or UK will reach out to you as tax practitioners seeking your opinion or advice that look guys, we want to do business or at least open accounts here. um, so is there an exchange of information protocol already in place in UAE with respect to our with respect to my country where I come from, because I'm planning to relocate. As a matter of fact, quite a few gray individuals are doing that, who are facing litigation in, for example, in their particular home country, and they want to move their wealth or otherwise relocate to UAE. They do that. They seek that kind of an opinion from you, and in that case, you will have to, look up for the competent authority agreement, or in case of US, you will have to look for the IGA, intergovernmental agreement, so that you may provide an opinion or advice. Common reporting standards. The CRS contains the reporting and due diligence standards underpinning the automatic exchange of financial account information before exchange can take place. An implementing jurisdiction must have rules in place requiring financial institutions to report information consistent with the scope of reporting required, and must follow due diligence procedures consistent with the procedures outlined in the MCAA and in the CRS. So I'm sure central bank, for example, here in UAE, or the Dubai Financial Services Authority, which supervises or regulates DIFC, or for that matter FSRA, which is Financial Services Regulatory Authority, which oversees the ADGM Abu Dhabi Global Market. I'm sure they have internally, promulgated or issued rules for which become the local law for UAE to exchange information under such master agreements with various countries. The CRS establishes rules to identify persons in respect of whom information is to be reported. The country to whom the information is to report, which person is required to report information, and any exemptions available for the information not having to be reported. So, under these common reporting standards, we find out what to report, who to report, and especially what not to report and who not to report. In this lesson, we consider some of the principles establishing and explaining the requirements. The section summarizes the information required by the CRS to be exchanged and who is required to provide that information. And at the conclusion of this lesson, candidates will recognize the similarity of CRS information requirements to the FATCA requirements. That's what I was saying. Quite a few provisions are very similar to FATCA. The information to be reported by each reporting financial institution on each reportable account. Let us have a look at it in more detail. Individual. So, right, again, you will find quite a lot of similarities. The name, address, jurisdiction of residence where the person is living, tax identification number, date and place of birth of each reportable person, that is an account holder of the information. A TIN is not required to be reported if a TIN is not issued by the relevant reportable jurisdiction or the domestic law. For example, here in UAE, an individual may not have a TIN issued. Why? Because there is no personal taxation. Unless that individual is in business, he may not have a TIN, or as we call it, TRN. TIN is the terminology used in Saudi Arabia. Domestic laws of that relevant reportable jurisdiction does not require TIN to be issued to. The place of birth is also not required to be reported unless the reporting FI is otherwise required to obtain and report it under the domestic law, and it is available in the reporting financial institutions electronically searchable data. Place of birth may have an exception. Entity. The entity is identified as having one or more controlling persons, each of which is a reportable person. So, those individuals or those beneficial owners who own the entity, they might be seen as the reportable persons. The name, address, jurisdictions of residence and TINs of the entity, and the name, address, jurisdiction and residence, TIN and place of birth of each reportable person, which are the UBOs basically. Again, a TIN is not required to be reported if a TIN is not issued by the relevant reportable jurisdictions, or the relevant reportable jurisdictions law does not require. In case of individuals, we don't have still we don't have personal taxation. Maybe Oman will be the first one to start the personal taxation. Account number, name, identifying number, and balance or value. As the name automatically suggests, so the account number needs to be provided. Name and identification number of the financial institution need to be provided. Account balance or the value, and again we read cash value of insurance contract or annuity contract, or the surrender value. Exact same wordings as the FATCA requirements. Total gross. So in case of custodial accounts, again it is being repeated: amount of interest, total gross amount of dividends, then uh, income generated on assets held in account, redemption, proceeds from the sale of redemption of the financial assets, same thing. In case of depository account, total gross amount of interest paid or credited to the account during the calendar year. Any account not described above is uh, is total gross amount paid or credited to the account holder on the account during the calendar year for which the reporting financial institution is obliger or debtor, including the aggregate amount of any redemption payments made to the account holder during the calendar year. So these words obliger and debtor, basically the opposite of the debtor is creditor, but here it is written as obliger. Why? Because in our IFRS, I think you might have read when we were reading IS 37, which was provisions, contingent liabilities, etc. So the word liability itself is defined in terms of obligation, right? If you guys recall that. So that is why the word obliger is written here. So if the financial institution has money to receive from someone, or has received money in case of deposits, then that information may be required to be provided under the common reporting standards. Currency. So currency of transaction. I think we have read this before as well, that this reporting will be made in the currency of denomination of the transaction. Account holders residence jurisdiction. The account holders residence jurisdiction to be reported is the residence identified by the reporting financial institution for the reportable person for the relevant calendar year. So, financial institution will already have the information as to where this person is living. So, that information has to be provided by having followed the recognized due diligence procedures. Where a reportable person is identified as having more than one resident jurisdictions all the jurisdictions of the residents are to be reported. The identified jurisdictions of residents that are without prejudice to any residence determination made by the reporting financial institution for any other tax purposes. In short, FI has information on the account holders, and that information is quite comprehensive because of the very strenuous KYC requirements. So all that information has to be reported under the common reporting standards. The Now we're looking at the general due diligence requirements. The commencing year of an information exchange on a reportable account is the year in which the reportable financial institution, by applying due diligence, identified it as being reportable. Uh, so there were criteria. We saw the criteria earlier on as to which accounts will be reportable accounts. The information to be exchanged on that reportable account is to be reported annually in the calendar year following the year to which the information relates. I think 9 months is going to come somewhere. Identification of an account as being reportable partway through the year does not prevent information on that entire year being reported. Does not prevent information on that entire year being reported. So let's say one account was previously not reported, but maybe halfway through the year it became reportable. So it will not mean that the rest of the time period, the previous ones when the account was not reportable, need not be reported. It will be reported. A financial institution is a non-reporting financial institution when it is a government entity, international organization, central bank, uh, other than with respect to a payment that is derived from an obligation held in connection with a commercial financial activity of a type engaged by a specified insurance company. So general rule is that a government entity or international governmental organization, international organizations or central bank, etc., they do not need to report. They will be non-reporting financial entities. So quite a detailed mention here. Other than so there are certain exceptions as well. Not Let's go to the next part. A reporting FI is any participation jurisdiction financial institution which is not a non-reporting financial institution. So what they have done is they have identified or explained the non-reporting financial institution first, and then based on that they said whoever is non-reporting financial institution will be a reporting financial institution. It is also important to differentiate between a reportable account and a reportable person. Okay, let's have a look at it. So what is a reportable person? A person is a reportable jurisdiction person except if it is a corporation, the stock of which is regularly traded on established securities market, a corporation which is a related entity to a listed company, and the third one, government entity, an international organization, central bank, or a financial institution. So again, in this, we have repeated the concept that we discussed earlier that a person is a reportable person unless that person uh, the shares or securities of that person are listed on a stock exchange. Even the related parties of those listed persons are exempt, and then the government organizations or international organizations or central banks are also exempt. Then the uh, reportable accounts. An account is reportable if held by one or more reportable persons. So it's as simple as that. In the previous one, we understood what is reportable person, and reportable account, it is the account held by the reportable person or by a passive NFE, non-financial entity, with one or more controlling persons who are reportable persons. So it was a non-financial entity and it was a passive one as well. But the problem is that one or more controlling persons were reportable persons. Then it has to be reported. I think active NFE exactly the same as we read in FATCA. That means 50% of this of their gross income should less than 50% of their gross income should be passive income. Less than 50% of the assets of that non-financial entity should be those assets which are giving rise to that passive income. During the preceding calendar year are assets which produce or are held for production of passive income. Here, the time duration has been reduced to last year, preceding calendar year. In case of FATCA, it was a longer period. For this purpose, passive income is determined by the rules of the country applying the law and generally refers to the portion of gross income consisting of dividends, interest, etc., royalties, etc. All of that is passive income. Now, controlling persons, this topic we read earlier on and we identified who are controlling persons. These are means natural persons exercising control over an entity, and for a trust means settlers of the trust, settlers or the trustees, the protectors, if any, beneficiaries, class of beneficiaries, and other natural persons exercising ultimate effective control over the trust. So this first paragraph was entirely constructed or addresses trust control. So if there are trustees who are you know mm, exercising control over the trust, and they can be settlers, protectors, and beneficiaries, all of them will be the persons who will be seen as controlling persons. For a legal arrangement other than a trust, this means persons in equivalent or similar positions. So anyone who can influence the decisions, strategic decisions, or that those will be seen as the controlling persons. Must be interpreted in a manner consistent with FATF. So exact same Financial Action Task Force has identified. So this is a repetition. I'm not going to, but yes, there's one particular point that we need to see. A control ownership interest, and it will be an interesting point because what we've read in accounting usually is that majority, 50% or more, power to influence. That is control. But here, let's see. A control ownership interest depends on the ownership structure of the legal person and is usually identified on the basis of a threshold applying a risk-based approach. For example, any person owning more than a certain percentage of the legal person, such as 25%. So it has been dropped to 25%. So FATF is like very, very conservative when it comes to matters of control, Financial Action Task Force. So they dropped the threshold to 25% instead of that 50 or 51% threshold. Where no natural person exercises control through ownership interest, the controlling persons of the entity will be natural persons who exercise control of the entity through other means, indirect. Where no natural persons are identified as exercising control of the entity, the controlling persons of the entity will be natural persons who hold the positions of senior management officials. So it's a kind of a decision tree if you really think about it, controlling persons. So the last line is the ones who are running the show, basically the management persons. But before that, yes, there are, settlers, benefactors, beneficiaries, etc. In relation to legal persons, functionally similar to trusts, for example, foundations. Can somebody tell me what is the difference between a trust and a foundation? Hello, guys, I have a question. Can somebody tell me the difference between a trust and a foundation? Now, we have read multiple times that a trust structure is not necessarily a legal personality, legal person. Can I say the same about foundations? Haya, Parjad? Anybody else? Moomin? Hello? Guys, can you unmute and participate in my question?
Uh, mm, no, trust is different from foundation.
Yeah, but like my question is, what is the biggest difference between a trust and a foundation? And it is important for you. I think Haya is demonstrating a lot of interest, but other guys are very, very silent. So what is the reason, guys? Mr. Tanu is answering the questions, but no one else is giving me replies on the questions. If you don't, I mean, these are very, very important aspects of this angle. So, Haya, what is a trust?
The main difference between them is the legal, the legal status. Because the trust is not a separate legal entity who are actually, running the trust.
So, can
And the
you can you
foundation, yeah,
can we say that a trust is similar to a partnership?
yeah,
Yes, actually,
no,
yes.
yeah, yeah, yeah,
Yes, we can. The only difference is that partnership is for a profit motive. Trust
yeah,
is holding assets or interests on behalf of others, right?
yes,
So it is an arrangement, it is a legal structure which does
yes,
not have a legal personality of its own, and trustees hold interests on behalf of other beneficiaries. That is trust. And then
yeah.
foundation, what is foundation?
Foundation is a legal entity,
Okay,
which is like which
I'll
is
let
which
me
is actually yeah, sure, sure, sure.
so foundation is a trust with a legal personality. This is the easiest way to explain it. Foundation has a benefit or advantage over trust. Why? Because in trust, it's a flow through entity. Trust is a flow through entity. It does not have a legal personality of its own. In case trust goes bankrupt or any other thing happens, trustees are directly exposed to the financial risks. But in case of foundation, there is another layer created. Foundation in itself becomes a personality, and the members of that foundations are akin to what we call trustees. But the important thing for us to remember is that members of the foundations, which we could have called shareholders, we cannot call them shareholders as such. They are we That's why we call them members. Members of foundation. They also run the foundation on behalf of other beneficiaries. They are not the beneficial owners. So this foundation structure right now in the world is the most popular structure because it provides one additional layer of protection. Okay. Other than it goes beyond trust, one step above trust. So that's the difference, guys. Please understand. Uh, One more point I would like to highlight at this stage is that under the UAE corporate tax law that we are going to start in the next lecture, inshallah, family foundations have been addressed. And if you guys are not aware, I think I should make you aware that in UAE, UAE is one of the very few jurisdictions of the world. I think Malaysia is another one. Some other countries also have that, quite a few, where foundation laws are already in place. That's one thing. And another very interesting angle I will tell you that at a federal level, a family foundation law has been introduced by the UAE. I don't know, maybe we will see this in the next course or lectures, but I would invite you guys later on to Google it and find out the family companies law of UAE, family companies law. So that law gives about how do the family companies operate. So, anyways, this was an interesting topic. That's why I took some time to address it. Let me, return to this. In relation to legal persons, functionally similar to trusts, for example, foundations. Reporting financial institutions should identify controlling persons through similar customer due diligence procedures as those required for trusts, with a view to achieving appropriate levels of reporting. So, uh, rep- reportable jurisdiction person. This is an individual or entity. What are we talking about? Reportable person, effectively. Basically, who is the reportable person? This is an individual or entity which is resident in a reportable jurisdiction under the tax laws of that jurisdiction. So, or a diseased estate which was a resident of a reportable jurisdiction. So, let's say we're talking about UAE for that matter. So, in case of an entity, the UAE will be a reportable jurisdiction when, for example, dealing with another country such as USA or UK, and the tax laws will identify, uh, who's the responsible person in this particular regard. Uh, in relation to partnership, limited liability partnership, or similar legal arrangements without a residence for tax purposes, it shall be treated as a resident in the jurisdiction at which its place of effective management is situated. So, but that's kind of deciding upon the tax residence of a person, and this is one of the criteria. Place of effective management is one of the litmus tests, but there are other criteria such as where was this incorporated or established. That's another consideration as well, and that will be the primary criteria actually under the tax laws. Secondly, reportable jurisdiction. Simply put, this is country that we're talking about. This means a jurisdiction which has entered into an agreement under which there is an obligation to provide information to be shared, and which agreement is identified in a published list. So when we talk about CRS, for example, in case of UAE, 78 agreements they have signed, but this is UAE only. But at a global level, around 100 countries have already accepted the model competent authority agreement. Uh, Participating jurisdiction. This means a jurisdiction with which an agreement is in place under which it will provide the information to be exchanged, and which is identified in a published list. So some countries have only participated. UICRS rules. Let's have a look at it. Now this was important. The government, by cabinet decision number 93 of 2021, has implemented certain provisions of the multilateral administrative agreement MAP, basically, for automatic exchange of information, which established rules and procedures implementing CRS. So this was the law. It was a cabinet regulation, cabinet decision 93 of 2021. Article 3 confirms the regulatory authorities applicable to the reporting financial institutions, their roles and responsibilities. The regulatory authorities for the reporting FIs are UAE Central Bank for Financial Institutions, subject to supervision under the applicable laws; Securities and Commodities Authority SCA for financial institutions, subject to its supervision under applicable laws and regulations of the Securities and Commodities Authority. So there may be certain financial institutions which are not regulated directly by the central bank, but by Securities and Commodities Authorities. So these are the regulatory authorities. Then financial free zones, as we have discussed or mentioned before. So two financial free zones are mentioned. Actually, there are three. There is RAC ICC as well. But anyways, so for DIFC, the supervising authority, you must have heard the name 1,000 times from me. It's called DFSA, Dubai Financial Services Authority for DIFC, and FSRA for ADGM, which is Financial Services Regulatory Authority. Then we have Ministry of Finance, for the financial institutions not otherwise regulated by any of the regulatory authorities. So I think now, since uh, some changes have happened, this was an old decision. This happened in 2021. One more authority has been established in UAE. It is going to be of a high importance going forward because of the technology changes, and it is called VARA, Virtual Assets Regulatory Authority. So the fintech companies or virtual asset companies, VASP we call them, Virtual Asset Service Providers. So those are regulated by VARA. If it is not written anywhere, you guys might want to make a note out of it. The insurance commissioner for UAE regulated insurance companies, this again has been outdated because now the insurance companies are also under central bank. Previously, there was a separate authority called IA, Insurance Authority. But later on, through the action of the federal government, insurance authority became part of the central bank. The functions are as follows. Now we are looking at the CRS functions. CRS functions for each regulatory authority for the financial institutions covered by its regulations are for the implementation of the agreement, the CRS, and the resolution in coordination with the competent authority. Let us have a look at it, the functions of CRS. To issue the necessary regulations, guidelines, and due diligence procedures. Issue the necessary forms required to be filed for the purpose of insurance compliance. These are the responsibilities of these authorities actually. Collect information and supporting documentation required to be submitted by reporting financial institution, account holder, controlling person. Review the information and supporting documentation filed. Provide the competent authority with information, document, and records within its possession relating to a financial institution, account holder, and controlling person within the period specified in the request. So, this much information these supervising regulatory authorities must provide. Undertake reviews and investigations as may be required to ensure compliance with any other rules or regulations issued in the state and in accordance with the guidelines issued by the competent authority. So, basically, investigation and reviews. Another thing that we are looking at, the functions. Undertake risk assessment and audit procedures as may be required to ensure compliance with the provisions and any other rules or regulations issued in the state. So risk assessments basically. Request information or documents. So information retrieval from financial institution on the reporting requirements. Impose administrative penalties. Administer the procedures and mechanisms for appeals against administrative penalties. All of these things will be done by the regulatory authority. Uh, Exercise any other powers and functions as may be required to implement and ensure compliance, and undertake any further functions or powers as may reasonably be required for assisting the state in complying with its obligations under any international agreement or similar instrument relating to the CRS. So, basically do anything that is not covered in the previous. In administering the rules, the Federal Tax Authority has been delegated to A, undertake risk assessment and audit procedures, impose the administrative penalties stipulated under the resolution, and C, administer the process and mechanisms for appeals against administrative penalties, while the Ministry of Finance and the FTA are delegated jointly to administer the remaining obligations. So let me just highlight to you that I've had the opportunity of basically working with one of the free zones in UAE without taking the name, and it was an engagement related to ESR, economic substance reporting. So how these financial free zones, for example, they interact with the Federal Tax Authority is It's a very close-knit mechanism basically. So although the information may be of fiscal nature, such as the ESR, still the process is regulated or process is conducted or administered by the regulator or the supervising body. And then all the information gathering, all of that is performed by the free zone, or for that matter the regulator, and then it is submitted to Federal Tax Authority basically. And if there are any actions to be administrative actions to be taken, or further information is needed, FTA reverts back to the regulator or the supervising body, and then the regulator disseminates that information to the account holder. That's how things move here in UAE. So you guys will need to remember this mechanism. Administrative violations and penalties. So Article 5 of the resolution, the same resolution we were talking about earlier, which was the cabinet resolution issued in 2021, I think 90 something, lists the administrative violations and penalties applicable when a reporting financial institution is provided a false or incorrect self-certification, fails to obtain a self-certification, fails to report, fails to provide complete and accurate information, breaches CRS, due diligence obligations, fails to comply with the resolution or any of the CRS laws or regulations, and other administrative penalties. The individual causes and the fine amounts, which are substantial, follow. So, you know, an account holder has to provide CRS related information to banks, to financial institutions, to insurance companies. And if they fail to do that, uh, penalties will apply. Let's have a look at it. Providing false or incorrect self-certification fines are AED 20,000 on any account holder or controlling person if the self-certification or any supporting document submitted by such account holder or controlling person to the reporting FI contain any inaccurate or incorrect information, and the account holder or controlling person knew or should have known that the information provided is inaccurate or incorrect. Uh, on finding the violation in the one reporting, FI shall, within not later than 30 days from finding the violation, notify its relevant regulatory authority or the violation of the violation and of all the information available to it on the identity, address, and place of residence of the violator. So that's what happened in that free zone where I was working as well. Those who had who failed to comply with the provisions of ESR, actually the Federal Tax Authority went back to the free zone, informing them about the penalty, 50,000 dirham penalty imposed on those violators. And this is how the information is reached. The relevant regulatory authority shall, within 30 days from the date of the notice referred to in paragraph 2, notify the violating account holder or controlling person, as the case may be, of the amount of the fine and require them to pay the fine within not later than 30 days from the receipt of the notice. So basically a 30-day period applies. The fines for failure to obtain a self-certification is 81,000 dirhams, as is charged to the reporting financial institution who opens an account for an account holder or controlling person without obtaining a valid self-certification and or failing to validate such certification. So there is a fine applied on the financial institution as well. Failure to report fines. Okay. 85,000 on a reporting financial institution that fails to submit the report on reportable account information to the relevant regulatory authority in accordance with the form, manner, and on the date specified by the competent authority. So, failure to report will incur a fine, 5,000 dirham. 1,000 dirham for every day. Oh my God, that's a very tough one. The failure to report continues up to a maximum of AD 100,000. So interesting, up to 100 days. Every day 1,000 dirham fine will accrue. AD 10,000 on a reporting financial institution which fails to submit a nil report in accordance with the time frame stipulated by the relevant regulatory authority, and AD 1,000 for every day the failure to report continues up to a maximum amount of 30,000. So basically, a nil report has to be submitted for saying that, if in case there is no exposure or no implication for particular reporting, that this person has a zero balance or no implication arises, even that information is not submitted, there's still a fine. Failure to provide complete and accurate information fines. Again, a reporting FI that fails to report the required complete and accurate information shall be subject to a minimum 5,000 dirham fine and a maximum 25,000 dirham fine, for which instance of a filed report in which such failure occurs in a reporting date. So, uh, in short, I mean, you don't file a complete and accurate report, again, minimum 5,000, maximum 25,000 dirham fine. A report, and this is for reporting FIs. Reporting financial institution that continues to fail to provide complete and accurate information in the reporting year immediately following the reporting year in which the violation is committed is subject to 10,000 minimum and 50,000 maximum fine. So that means, you did not improve, continued to be negligent. A reporting financial institution that commits the violation set out under the paragraph A of this clause in any further successive reporting years following the reporting year specified in paragraph 2 shall be subject to 60,000 dirham minimum fine and 100,000 maximum fine. So naturally, it shows a pattern of negligence. So that is why the minimum fine is increased to 60,000. Failure to comply with CRS due diligence obligations fines is 40,000 for a reporting financial institution failing to apply the regulatory authority CRS due diligence rules. Due diligence, if the financial institution does not perform proper due diligence procedures, then fine is 40,000 dirhams. Fines for failing to comply with the resolution or any of the CRS laws or regulations are a reporting financial institution is liable to a minimum of 10,000, maximum of 30,000 fine. And furthermore, an AED 25,000 penalty shall be imposed on any reporting FI committing any offense in violation of any other provision of the provisions of the resolution or any other applicable laws and regulations issued in the state in relation to the CRS. So, any kind of non-compliance, there's still fine, or adopts any practices in respect thereof with the intent to circumvent the regulation. Oh, so, try to circumvent the regulation, there is a minimum 25,000 fine. So quite a few fines have been imposed on financial institutions. As a matter of fact, there are other administrative penalties as well. Reporting FI commits any of the violations stated above, the relevant regulatory authority may impose any other supplementary penalties as it may deem to be necessary, including the suspension, withdrawal, or non-renewal of the license issued to the violator. So that's why central bank is very tough. Even SCA, Securities and Commodities Authorities, is quite tough. The relevant regulatory authority shall notify the reporting financial institution of the administrative penalty taken in pursuant to paragraph A of this clause and the time frame in which such penalty must be paid. So, any other violations which could be so serious that their license may be renewed or withdrawal or suspension, etc. They will inform the person and give them time to be heard. Okay, so now we are on exchange of information, which Article 9 of the resolution requires the competent authority to annually exchange information with a foreign competent authority on each reportable account in accordance with the form, time, and manner specified under the agreement and pursuant to any further international agreement, treaty, or similar international arrangement to which the state, meaning UAE, is a party and is related to the CRS. So now what we are reading is exchange of information. So Article 9 of the resolution requires competent authority to annually exchange information. So the competent authority is required to issue the necessary forms to be used for implementing the resolution, prescribe the dates and manner uh, of in which the information is reported by a reporting financial institution, receive and request the information required to be reported under the resolution. So all the form and manner and everything that has been covered in Article 9. Request the relevant regulatory authority or reporting FI to provide any such additional information. So there are three terminologies used here. If you read it, one is regulatory authority, then another one is reporting FI, and then there is another terminology used, competent authority. I'd like to ask you what is meant by each of these three terminologies. One is competent authority, then there is a regulatory authority, and then there is a reporting financial institution. Who can answer this question? What is meant by competent authority? Kalima, are you there? Kalima, can you please unmute?
Yes, Mr. Altaf.
So what is meant by competent authority?
Uh, Maybe
So,
someone who's the organization that is having
okay, what is
like
meant by
a power over
what is meant by reporting financial institution?
reporting authority one.
Okay, I don't think you were even listening to what we were talking about. It was just
I was not here.
you're not. Haya, would you like to say something on this? Reporting financial institution, regulatory authority, and competent
Uh,
authority.
Competence authority would be the authority which enforce laws and regulation.
Then what will be the regulatory
Uh,
authority? That also enforces laws and regulation.
for example, I think competence authority would be MOF, Ministry of Finance, and regulatory authority would be FTA. And if, for example,
Do
I
do
talk
you
about,
okay?
is it right?
Do you recall we saw quite a few competent uh what do you see this? Do you
Voting
see this
FIS,
chart?
yeah. UAE Central. Yes, yes, yes.
This is regulatory
Mm,
authorities. Okay. These are
okay.
regulatory authorities, first of all. One question answered, right?
Yes.
What would be competent authority then? Okay, forget competent authority. Let's talk about reporting FI. That's an easier one, right? Financial
Reporting
institution by
FIS are the regulatory authority, I think.
नहीं
Financial
FI
institution.
FI financial institution भाई reporting financial institution reporting FI banks basically
Banks, yes.
banks.
Yes.
What else?
Financial
What
institutions.
are banks the only reporting FIs?
No, the financial institutions, insurance companies
Okay, what else?
also.
There could be another type as well.
I think you
Uh,
mentioned depository institutions before.
Depository institutions are those who accept deposits, and only banks usually
yes,
accept deposits in UAE.
So
yes,
that means they are not reporting financial institutions.
They
They
are reporting financial institution,
they
but
are.
what I'm asking is, other than banks and insurance companies, can there be other financial institutions as well? That was my question. What about
There are.
what about investment companies?
Yes, they are.
What about commodity trading companies? I mentioned one free zone, if you remember. What was the name of that free zone? DMCC, remember?
DMCC.
Yeah, Dubai
Yes.
Multi Commodity
Dubai
Center,
Multi Commodity
right?
Center.
So their
Yes.
commodity trading is done. Commodity contracts are traded. So and what about the investment companies? Which are the two best financial free zones which host a lot of investment?
DIFC,
Yeah, and
and there was another one.
ADGM.
Mark. ADGM, yes.
So whenever
ADGM.
DIFC comes, you should always remember ADGM. So they are both,
ADGM.
both kind of brothers. DIFC,
Okay.
ADGM. So
Okay.
now it should be clear that all of these categories are reporting financial institutions. Clear? The second thing is regulatory
Yes.
authorities. So, okay, for insurance companies, who's the regulatory authority? Farjad, are you there? Mr. Farjad, are you there? Or Abbas? Abbas, you have not spoken anything all day. Chalo, okay. Let me ask you guys, give you a hint. Banks, insurance companies, even the exchange houses, all of them are regulated by one entity. Which entity would that be? Central bank. Okay. So these are the financials. Which authority is going to regulate the commodity trading? We mentioned a free zone name,
Mm, DMCC?
right? But that DMCC is a free zone. Which will be the
Yes, Freezone.
authority? Which will be the authority that will be controlling?
Ministry of Finance?
No. Securities and Commodities Authority, SCA.
Yes, I see it.
Do you remember that? We read the name here. Can you see here?
Yes.
Guys, at least remember these, very important for you guys. Securities and Commodities Authority. This is a key thing, okay? Central bank regulates banks, exchanges, insurance companies, and quite a lot of other things. Uh, but Securities and Commodities Authorities regulates those financial institutions which are not regulated by central bank. Then these two authorities that we mentioned, these are also these will probably regulate more investment companies. But central bank also, I think, regulates investment companies as well in the mainland. And naturally, Ministry of Finance is there. Anyways, I hope quite some of the people have woken up. But anyways, let's move forward. Uh, receive and request the information required to be reported. What were we doing? Competent authority is required to do all of this, okay? That they have to provide the manner and in which the information will be reported. Receive and request the information to be reported under the resolution. So they will ensure, basically the competent authority will ensure, which is Federal Tax Authority, will ensure compliance with the regulation. And Federal Tax Authority by default means Ministry of Finance. Again, the same thing came, UAE regulators, but we've read that. So I'm going to move forward with that. This was my question actually. So it's an introduction about the various regulators. So the biggest of them, the biggest, baddest wolf in the market, central bank. So it's the most powerful institution that regulates all the financial paradigm of the UAE, has issued the implementation of certain provisions of the multilateral administrative agreement in 2020. So that this is central bank. That resolution, the components of the resolution are regarding the CRS, that based on the coordination with the Ministry of Finance on the CRS, and have regard to the fine, revised draft of the CRS guidance notes. So essentially, to summarize it, central bank is deeply involved with the common reporting standards and it is regulating. So there was another resolution provided for the Ministry of Finance to be authorized to collect and exchange information and data on natural persons. Ministry of Finance, when exercising the powers conferred upon it under the resolution, shall coordinate the relevant federal and local authorities in all matters relating to specifying the type and nature of the information. These authorities are to cooperate with the ministry in implementing CRS provisions. Now, Securities and Commodities Authority, that's another regulator, right? So let's have a quick look at it. Under the decision, now we are heading towards the close, inshallah, because we've come to the point of regulators. Ensure the decisions providing uh, require the licensed entity adopting the common standards for tax reporting, required the licensed entities clients being subject to the common standards for tax reporting, and C, apply to any other person whose dealings are subject to the supervision and control of Securities and Commodities Authority to be subject to the common standards for tax reporting. So, Haya, just for your information and for others also who may not be listening right now, but please, participate better. Mr. Tanu is participating and Haya and some other people, but SCA in a way is equivalent to Securities and Exchange Commission. In other countries, it is known as Securities and Exchange Commission, but here it is called Securities and Commodities Authority. So require all
Okay.
require all addresses to apply and implement the common standards for tax reporting attached to this decision. So basically, uh, SCA is the local SECP or SEC. This is an outdated one, but we can still read it. Why? Because Insurance Authority has now become part of the central bank. The Director General of the Insurance Authority issued to all insurance companies operating in the UAE a circular 2020 covering the CRS. The Director General wrote that in line with the provisions of Cabinet Resolution of 2020, attached a copy of the amended guidance note for the common reporting standards. So, what do you see in common here, Haya? Like in the central bank also, there was a notification issued to the various banks. In case of insurance authority, at that time in 2020, again the Director General of Insurance Authority issued a notification. So, who is administering the process of common reporting standard? Is it FTA or is it the regulators? It's the regulators.
Regulators.
Regulators, yes.
Yeah,
Regulators are
regulators.
administering the process. So FTA is in the background, basically, issued by the Ministry of Finance for implementing and requiring insurance companies forthwith to start implementing the standards. Then we look at DIFC. We read a very detailed thing on DIFC and ADGM before. So, but it's only probably about the law, about the notification or enforcement. Let's see. A brief announcement made by the central bank, SCA, and insurance commissioner, essentially instructing the persons which each regulator to adopt CRS guidance notes are to be contrasted with the detailed and lengthy CRS statements issued by DFC and ADGM. That's why we say that DIFC and ADGM are the pride of UAE because they have very detailed guidance on many matters, which the other regulators have issued very appropriate guidance, but these two take the prize actually, DIFC and ADGM. Both the later regulators established their own principles and procedures which fairly represent and incorporate the most important provisions in the CRS and guidance notes on when, where, what, and how reporting FIs are to report to the UAE competent authority. So let's see a review of the regulations. So these are DIFC CRS regulations 2020. But if you ever visit DIFC website, you'll find very detailed legal framework of DIFC. One of that very small one part is it's probably 1200 pages long, website pages actually, so on which the law of the DIFC is published. A review of those regulations confirms that the contents are based on the UAE CRS, which in turn is based on the OECD CRS. So effectively, what is mentioned by the OECD, DIFC has adopted, and that is something that we've read in detail. So I don't want to take you into a lot of detail here, but generally speaking, uh, these are prepared in exact similar lines as we studied earlier on when we were looking at the CRS content. So due diligence should be there. Pre-existing individual accounts should be addressed. Due diligence for a detailed due diligence framework is identified for new individuals. Pre-existing entity accounts have been addressed in there. Due diligence for new entity accounts have been mentioned, addressed here. AML KYC considerations are identified. All those particulars, name, uh, place of birth for the controlling persons, the same things are being reproduced here. Special due diligence rules, so which is called enhanced due diligence sometime. EDD, that has been identified, that what needs to be provided. Some quite a few terms have been defined in it, like terms we read as controlling persons, reportable account, reportable entity, etc. Those terms have been defined as well. Naturally, whenever DIFC comes, always the brother always comes, ADGM. ADGM regulations at 41 pages are more extensive than those adopted by the DIFC. But again, quite a few similar things are there. Any reporting FI is subject to supervision of the regulatory authority. The account holder of a reportable account to be properly reported by the financial institution. Any other person to whom the regulations apply. So I'm not going to take you into a lot of detail, but essentially it is again on the same lines as OECD. Reporting the role of power of regulatory authority, details have been identified for the powers of the uh, it's a small quick quiz I'm going to ask. Two questions I'm going to ask, and I need answers to those. So which is the regulatory authority for ADGM? Guys, I need the answer.
Secure.
Not securities.
No. No.
What is the name of the regulatory authority for the free zone called ADGM? If you do not remember it, please note it down for future reference. The answer is FSRA, Financial Services Regulatory Authority of Abu Dhabi. Okay?
Can you repeat this?
Financial Services Regulatory Authority, FSRA. This is the name of the regulatory authority for ADGM. Okay. And the other question is, what is the name of the regulatory authority for Dubai International Financial Center? Anybody?
No.
Dubai International
Dubai
Finance,
Financial Authority
Dubai Financial
Services.
Authority. Correct. Correct. Good. Dubai Financial Services Authority, DFSA. Okay. These two names you guys should remember, and when you get time, at least pay a visit to their websites, so that you may find out how detailed their regulatory frameworks are. That's why practitioners particularly dealing in DIFC and ADGM, they make huge amount of money because their reporting and compliance requirements are very, very extensive. And mostly all the multinational international players are sitting in these two financial free zones. So I would advise you guys, particularly the practitioners like Abbas or Haya, to focus on this. Okay, go into it. Having this kind of a knowledge may even land you a major, starting pay of 40,000, 50,000 dirhams. Record keeping part contains the regulators reporting FI record keeping requirements. So quite a few record keeping, contravention and enforcement and appeals, all the procedures have been detailed in these regulations. Indemnity, effective date, definitely. So let's see what is the next thing. Schedule 1. Which Schedule 1 are we talking about? Let's see. The automatic exchange. These parts mirror and replicate the materials covering the same topics in the UAE and OECD CRS. So I think this Schedule 1 is basically the continuance of ADGM's reporting framework. So in this schedule, the general reporting requirement, due diligence, what we saw, enhanced due diligence, new entities, pre-existing accounts, all of that repeated in here, so on the same lines as DIFC, but slightly more in detail. So I think now guys are ready. Kalma and Haya and other personnel, if Mr. Tanu would like to participate, I would appreciate. Let's see. We are starting off with the quiz. So let's read this. Select the correct answer to complete the following statement. US persons, regardless of location and regardless of dual citizenship, are required to annually self-report their dash assets to FinCEN.
Non-US.
Non-US?
Yes, non-US.
Kalima, what do you think?
Don't remember.
Yes. So, Kalima, the part that you missed out, basically, we were talking about non-US assets, foreign assets, which should be reported to IRS. Do you know what is IRS? If you read FATCA, then you should know what is IRS. IRS stands for Internal Revenue Services of the United States of America. That's the tax authority of USA. Second, select the correct answer to complete the following statement. US entities making payments to non-compliant FFIs. What was FFI? Anybody? Come on, guys. FATCA we studied in detail. FI stands for financial institution. What would be this F?
Foreign
Yes.
financial institution.
US entities making payments to non-compliant foreign financial institutions are required to withhold tax equal to, remember?
25%, 30%,
30%.
25% or 30%.
I
Yes.
think 30%. Let's see. Right? That was a major blow, basically, if you really think about it. 30% of the payment. So what was that? US entities making payments to non-compliant foreign financial institutions are required to withhold tax equal to 30% of the amount. Huge blow. Number 3. Select the correct answer to complete the following statements. Dash foreign financial assets are foreign financial accounts and foreign non-account assets held for investment. Yes.
Specified.
Specified? Yeah. Specified
Yes.
foreign financial assets. Yes. Okay. Number 3, true or false? A depository, that's an easy one. A depository institution is an entity holding as a substantial parts of its business financial assets for the account holders.
False.
Hmm.
Mm.
Yeah.
It's not a substantial portion, it's false.
No, it's entirely wrong. Depository institution is
Yeah.
one that accepts deposits.
Deposit. Yes, yes.
So, okay, next. Select the correct answer to complete the following statement. A reporting UAE financial institution will not be required to report on accounts it holds if the account holder is an active non-financial foreign entity, passive.
It says does not or
Yeah.
do report.
A reporting UAE financial institution will
Will
not be
not be
required
required.
to report on accounts if accounts it holds if the account holder is an active non-financial foreign entity, passive non-financial.
Active
Passive.
NFP, the active one, the first one.
And can you recall, Kalima, that why was that active non-financial foreign entity?
Because it does not meet the, I think it's not a foreign reporting institution.
There was a withholding tax agent requirement there,
Yes.
withholding agent that they have shown to the IRS that we have complied with the requirements. We meet the criteria of the non-financial foreign entity. We have appointed a tax agent, or the account holders are already there. They enjoy the exempt status under the IRS. Remember that various exempt statuses were there. That was the reason that active NFFEs, they may enjoy this benefit. So let's see, right? A reporting UAE financial institution will not be required to report on accounts it holds if the account holders is an active NFFE. Okay, fine. We read that. Okay, let's go to the next one. The common reporting standards consist of the following key components. What components should be there? Common IGA was in CRS or FATCA?
FATCA, I think.
FATCA, yes.
MCCA was
MCAA, Model Competent Authority Agreement. That was part of the CRS. Why? Because it came as the OECD's convention on MAP. Remember, right? There were four
yes.
things. There were four elements mentioned there. If as I recall, the common reporting standards consist of the key components. MCAA was there. Then the standards themselves. What else was there? There were four things. Commentaries on the CAA, and this one. The method of how the information will be exchanged. Remember, XML, through the exchange of XML language, language transformed exchange of information. And then there was a detailed commentary on the model convention, right? These were the four things. MCA is the model agreement. This one is the commentary on that agreement. And then CRS are the reporting standards themselves. And then the fourth one was this. I don't think you remember, Haya?
I remembered MCA.
Yeah. So these are the four components. Okay, guys. Then let's look at this. True or false? the competent authorities will automatically exchange the information in the CRS schema in hypertext markup language. Oh God, do you know what is hypertext markup language? It's called HTML. And then there's another called XML. Which was it? XML or HTML? We just
XML.
XML. So
XML.
that means this is false, right?
Yes.
See, in what's written in extensible markup language, XML. Number 8. Select the correct answer to complete the statement. The dash updated its CRS rules in August 2020 through the decision of the authority's chairman of the board of directors, decision number 21, chairman of 2020, concerning the common standards for tax reporting. In 2020, one of them did that. Who did that? Was it Securities and Commodities Exchange or IGA has no process of elimination. IGA is irrelevant here. IGA means intergovernmental agreement. CRS, again, this is it is the name of the standard itself, common reporting standards. So these two are gone. What is left is ADGM and SCA. So now this is a test of memory. I mean, I may also give a wrong answer, but anyways, so what is your view? Which one was that? Updated the CRS rules in August 2020 through decision of the authorities authority. They mentioned authority. So I think it is Security and Commodities
CSA?
Authority,
CSA? Oh, SCA, sorry.
SCA. Let's see. Yep. So we were clever. True or false? The Director General of the Insurance Authority issued to all insurance companies operating in the UAE a circular number 34 of 2020 covering CRS. Again, test of memory. But see, let's say, is this true? Yeah, I think it is
I
true. I mean,
think it's true.
it's true. I
Yes.
think. Why? I think the year is correct. 2020. Yep. Okay, last one. Select the correct answer to complete the following statement. The rules the DIFC has published for conduct of CRS within the DIFC are known as the CRS dash consolidated version number 2 in force on 30th July 2020, 24-page document. Okay, what is that? Are this considered as the CRS what? Conduct guidelines or framework or regulators or regulations?
Framework?
I don't know.
Regulations?
I think regulations. Shall we?
Yes.
Bismillah. Okay. Okay, guys. Great. Perfect. Thank you very much. Let us look at the recap of what we studied today. By completing the module, you can describe the US and global markets for exchanging financial account information, assess compliance with FATCA reporting obligation in order to avoid penalties, identify the validity of all CRS data captures and reporting obligations, and the fourth one, determine how the MCAA details what information will be exchanged and when. And that is it. Inshallah, we will. So next, just let me show you guys something. So this was module 7, right? This is financial account information exchanging that we finished just now. And this is part B. We've concluded the part A, entire part A we've concluded, which comprised of the 7 modules. Okay. All the first 7 modules are completed. Now what we are left with is the next modules and 6 modules. But these modules are purely corporate tax modules. So please remember that history of taxation and corporation business in the taxation. This is UAE related. Tax base and taxable income, reliefs and concessions, transfer pricing, returns, assessment and administrative compliance, and anti-abuse, etc., and special entities. So, anyways, next is a very, very critical, crucial module. Please do not miss and pay high attention. Okay, guys, thank you very much for your time. Inshallah, we'll meet next Saturday. Okay, thank you. Assalamu alaikum.
Thank you. Walaikum assalam.